Hey, welcome back to the program. Show's called Your Money, Your Wealth. Oh, sorry. So I don't know if you saw the label on the cup, but yeah, Pure Financial. Sorry, that's shameless.
That was shameless.
Let's
that
get
was terrible. Hey, wait a minute. I'm still thinking about something you said last segment.
Let's get to the true-false question.
All right, here we go. If I give a donation to charity greater than my income, I will forfeit that excess charitable contribution forever.
That's a great question.
It is a great question.
Because if I'm, in that last example, if you guys just joined us before the break, we're talking about some more or less advanced estate planning type tools and charitable giving type tools. And then you can create very large deductions, $100,000, $200,000. But wait a minute, if I only have $50,000, $100,000 of income, maybe I'm retired, I don't have a lot of fixed income, and I have this huge charitable deduction, is it all for nothing?
Yeah, and here's really how it works, is you're limited normally to 50% of your income as a deduction. So what that means then is if you make $100,000, you can give away $50,000 and have it be deductible. Now, when you give appreciated stock, then you only get to do 30% of your income, so that's $30,000. So if you have extra, in Joe's example where you had a $100,000 deduction, what happens is it carries over to next year, and you get 5 years to deduct it. You go through that same limitation, 50% or 30% of your income, and you deduct what you can, and then it carries forward the following year. So when you're planning your charities, when you have big deductions like a tax-exempt trust, make sure that you can deduct it within the time allowed.
A lot of good things there. And so I can take the deduction that year, and then it will continue to carry over. It won't carry for life, but it will carry over for at least 5 years, so you won't lose that deduction potentially. So a lot of good things there. Hey, you know, I was talking to Debbie Rossi, Big Al and I. She was in our office. She's the Director of Planned Giving for the Salvation Army. And so she was talking about a tool called a gift annuity. Big Al, I know that your family, actually your father, has used this tool before to create income, to get a tax deduction. So when you're looking at a couple of different tools and items to either create income and get a tax deduction at the same time, maybe a gift annuity might be something that you might want to look at.
Yeah, this is a pretty good one, Joe. So my dad's done this through the National Park Service Foundation. You can do it through a lot of different organizations. But here's what it is. You actually give money to this organization, and what they do is they give you back an income stream for life. And that the interest rate that you're getting on this income stream, it's just a little bit lower than you might get with a commercial annuity. So there is a charitable donation part. So in other words, you're getting a charitable deduction today, and you're getting a payment stream for life. So this is a case where, you know what, I feel good, I'm giving to an organization that I want to give to, but as long as I'm living, I'm going to receive a payment stream, or as long as my spouse is living, I'm going to receive a payment stream, and I get a tax deduction right now. So it really is a great thing to consider, particularly if you're talking about maybe $5,000, $10,000, $20,000, whatever it may be. When you're talking about the tax-exempt trust, like we talked about last segment, that would be probably for bigger assets.
Yeah, I mean, so there's a lot of different things. I think right away when people think about giving to charity, it's like, okay, well, the money's gone. But not necessarily. There's different tools that you can use that you can still provide yourself an income, get a tax deduction, and then also then at the end of life give a nice gift to a qualifying charity. So it's not, all right, well, here I'm just going to cut a check and give it to the charity, which is good, right? You get the tax deduction and everything's fine, but there's still things that it's a win-win. It's a win for you, and it's also a win for a charity. Hey, let's go to a quick email question.
All right, this is from Anthony in Huntington Beach. I have about $500,000 in my trust account and $500,000 in my IRA. If I give half to charity, if I want to give half to charity and half to my nieces and nephews, does it matter which assets I leave to charity versus my nieces and nephews?
So I guess and let me clarify the question here. So he's got money in a retirement account and he's got money outside of a retirement account.
Right.
And then so he's wondering, all right, well, which assets should I give to the charity? Which assets should I give to the kids?
Right, that's exactly, or does it even matter?
Yeah, so it definitely matters because,
Sure.
right, you want to give your retirement accounts to the charity because you can avoid the ordinary income tax versus the kids would get a step up in basis if they inherited you know, your trust account or assets outside of a retirement account. But I guess, Al, it depends on what his basis is as well inside, you know, the stocks that is outside of his retirement account.
Well, exactly right. And I think that's exactly what you want to do. If you're going to give to charity anyway, do it through your IRA, because the charity, when they get the IRA, they don't have to pay the tax on it. Now, if your nieces and nephews get it, they have to pay taxes on it. On the other hand, if you're giving assets that are not part of your IRA, they're going to get what's called a step up in basis, as Joe just said. So maybe you bought a stock at this level and now it's worth this amount, right? All that gain goes away when you pass away. The kids get it at a new cost basis, they sell it, they pay no tax. So really, that's the better asset to give to your nieces and nephews.
Well, 'tis the season to give. We talked about a lot of different strategies when it comes to figuring out, all right, well, can I create a tax deduction? Can I do good for me, but also do good for a qualifying charity? There's a lot of things that you can do. Hopefully you found this informative. And now it's time for you to take action. You have, what, a month left before the end of the year, December 31st. 99% of all tax planning needs to get done before year end. So get off the couch, start organizing things, and get things done. Thank you so much for joining us. Next week, we got another great show lined up. For Big Al Clopine, my name's Joe Anderson. You just watched Your Money, and it's your wealth. Have a great weekend, everyone.